off is if you speak to people coming into the space, perhaps those that are more risk averse, they will say, well, crypto is more risky than other assets. And I think you've done a really good job of arguing, well, that's actually not the case. In fact, most people don't fully comprehend the level of risk that exists in the existing system in pension funds or other ways that they might be allocating their capital, right?
That's right. So if people, it hasn't dawned on people that they could have lost all of their money in the banking system in 2012 in Europe. People in Cyprus understand. I mean, all of their money was wiped out. So there's the probability of total wipeout. And we've seen it time and time again within the financial system. We've got these other risks that we don't understand, such as the debasement of money. These are risks we don't really understand. There's also confiscation risks, and we see that periodically. Basically, we're seeing it in China now. We've seen it in Russia in the past. We're all running risks. Then we've got a pension system that's underfunded. And so people don't understand that the fact that what they think is a retirement nest egg, A, is going to be worth less in real terms, and B, is not enough. And we've also got the social security or state benefit system, which is underfunded, which could bankrupt governments. We've got a lot of these big existential risks. Are we getting rewarded for them? That, I don't think we are. We're not getting rewarded in government bonds anymore for the risk of something bad happening, whether it's excessive inflation or whether it's a government defaulting, which almost happened in Europe. So right now, Greek government bonds are negative. But if the ECB wasn't there, they'd default. And you'd lose all of your money. So Bitcoin looks riskier because it's more volatile. But what a professional does is look at the risk reward. What is the risk? Well, the risk is probably, call it 75% downside over a 2-year period. Is there a risk of it going to zero? It's almost negligible now. So let's call it a 75% downside. Well, still on average, it goes up 213%. So that's a 3-for-1 risk reward every single year. And over a 3 or 5 year time horizon, it tends to go up like 10x. And generally only with one of those drawdowns of that magnitude. So it's much less risky. Also because, as you talked about before, it's actually not correlated with other stuff. So most of us have legacy pension systems and houses that we bought and other stuff. Well, how does Bitcoin fit into that? Well, it's not correlated to all of that. So it offers benefits. So if the world goes to hell in a handbasket, chances are Bitcoin's going to appreciate in price. So it's a hedge. It's how people use gold in the past as well. But this happens to be gold for the digital age. And that's a very powerful thing. So it may be perceived as risky, but again, you're also looking at it through linear eyes. Just to explain to people exponentiality versus linearity. So if I take 20 linear steps across my office and into my lounge, I get, call it 10 meters across. If I take 20 exponential steps, I go around the world like twice. That's what people can't understand. How can that be? But that's what exponentiality is. So that is going to be volatile by nature, but it's going to be offset by the returns that you get.